I think everyone knows Rick. He's a CPA and an attorney who specializes in tax law in New York City and lives in Stonebridge.
Oh,
And if you want to add to that, Rich, you're welcome to.
oh, that's
Okay.
a lot of people know me. Practicing at this point.
You're fading.
Okay. We can't hear you, Rich.
Can you hear me now?
Yeah.
Yes.
Mark,
All
your
right.
camera's not positioned right.
Okay, how's that?
That's
I can hear
me
you.
now?
We can hear you.
yeah.
Okay. All right. Here we are, almost the middle of November, and we have another month and a half to go for 2020. So I would just recommend you to start just review your situation. First of all, look at your 2019 return, what happened last year, meaning 2019, and see if, first of all, is there anything unusual happening in 2020? Large increase in income or expenses, or a combination. But I recommend that you start taking a look at it just to see where you stand. It also gives you a month and a half to take any action for 2020. Okay. First thing I might probably take a look at the fourth quarter coming up. You may just want to review your withholdings and estimated tax payments. Last year, the first and second quarters were paid July 15th. The third quarter was September, and then we got the fourth quarter coming up in January. So they just want to review your situation to make sure you have enough paid
Excuse
in.
me, Rick. I just want to mute everyone, so except for you. Can everyone mute themselves?
How to do that?
Erwin, I think you.
Bottom left of the screen, you just click the microphone.
Okay, I think, is that better now? When it comes to, estimated tax payments, I mean, most of us are retired. So you just want to make sure that you have sufficient monies paid in. If you don't pay in a sufficient amount, there is an underpayment of estimated tax penalty. That's basically an interest charge for not paying your estimated taxes on time. There are certain safe harbors that you can go by. And another thing to keep in mind when it comes to estimated taxes is if you're going to be receiving distributions, say an IRA distribution or profit sharing, you can elect to have taxes withheld. In that case, you would mitigate your any penalties that you may have for underpayment of estimated tax. Now, a couple of things you may want to take a look at for the current year is going to be your capital gains and losses. Again, since most of us retired or semi-retired, it's probably the bulk of our income. Always good to review. The way capital gains and losses work is you net your short-term transactions, you net your long-term transactions, then you net the two, the short-term and the long-term. And if you have a net gain at the end of the year, if it's long-term, you get a preferential rate. If it's net short-term, then it's going to be taxed as ordinary income. Keep in mind, when it comes to capital losses, you're limited to $3,000 to deduct against other income. If you have a capital loss and you have capital gains, you can use the losses to offset the gains. But if your losses exceed your gains for the year, then you can deduct up to $3,000 against other income, such as interest, dividends, or salary, or other income that you may have. One way to cut down on capital gains, if you do have them or a substantial amount, you may want to take a look at what losses you have, unrealized losses, and you may want to sell some of your lost stocks to offset your gains, some of your gains. Keep in mind, you shouldn't be doing things necessarily solely for tax purposes. So it should make sense that you're it makes investment sense also that you're selling. But the loss harvest rules is one thing that financial planners have talked about towards the end of the year. Other thing you have to keep in mind with loss harvesting is that if you sell a stock at a loss, you're not allowed to reacquire it either 30 days before to 30 days after that 61-day window. If you do reacquire a stock that you sold at a loss, okay, then the loss is going to be disallowed and they'll adjust your basis on the new stock. So sold something for stock you paid, say, $10,000 for, and it drops down to $3,000, and you sell it, you're going to have a $7,000 loss. If you reacquire that stock or a substantially similar stock, includes options, then that $7,000 loss is going to be disallowed. It's called a wash sale. That would be disallowed, and then your cost or basis in the new stock that you acquired will be adjusted upward for that $7,000 disallowed loss. So you don't lose the loss, it's just you can't deduct it today. Here. Other things to keep in mind with capital gains and losses, you can carry forward your capital loss carryovers. You have net loss, a capital loss, net capital loss, you can carry that forward. So say in my example, that $7,000 loss, you have no other capital transactions. You have a $7,000 loss, you can deduct $3,000 of that loss against your other income. Still have $4,000 remaining. That $4,000 can get carried forward. Something just to be able to, just to be aware of the rules so you can plan accordingly. Other thing, keep in mind when there's no special rule when it comes to capital gains. If you sell a stock at a gain, you can buy it back tomorrow, and you still have to recognize the gain, tax on the gain. Congress has no problem if you want to sell things at gains, they're happy to collect the tax. Just when it comes to losses that they're concerned about, particularly when the market took the drop in March, and people were, wanted to sell and take losses, they had to be cognizant of this wash sale rule. Don't buy it back too soon. Again, measured, you look at the date of sale, look 30 days back. Say you sell it November 30th, 30 days back is November 1st, 30 days forward is December 30th. So that 61-day window, you acquire a stock that you want to claim a loss. One thing that you could do if you want to claim the loss, nothing says, say you want to double up on the stock. Right? Let's, I don't know, make it a stock up. Just let's say it's AT&T. And you like AT&T, but you want to be able to claim the loss, but you don't want to, no exposure to it. So you could acquire stock. In my example, you could acquire it in October 28th, or you acquire the stock in January after the fact. But if you're concerned about keeping exposure to a stock that you like, think about doubling up and buying the stock outside the Anyone have any questions about capital gains and losses before I go on the next
The
topic?
sound is not good. You're breaking out all the time.
How is this? Is this any better?
Yep.
Okay. All right. A big change that happened this past year deals with required minimum distribution. Changes. One was at the end of 2000.
Rich, you keep breaking in and out a little bit, and sometimes it's hard to hear you.
Is this better?
It is, I guess. Move, unless you could, okay, we'll see what.
I have the volume up as high as it can go.
Okay, all right.
Want me to get closer?
That'd probably help. A little closer.
A little closer? Okay, well,
Yeah, that's
see
better.
me here. Okay. Big change that took place this past year. We had that Secure Act made a number of changes. One is they raised the age to begin your required minimum distributions from 70 and a half to 72. Okay, and that was effective for taxpayers who turned 70 and a half in 2020. If you turned 70 and a half prior to July 1st, you were required to take your required minimum distributions under the old rules. For 2020, because of COVID, they have suspended the 2020 required minimum distribution. So if you were going to begin to take it in 2020, or if you were already taking required minimum distributions, you are not required to take it for 2020. And so that is something important to keep in mind when you're doing your tax planning.
So if you're not required to take your distribution in 2020, does that become a null? Are there any repercussions for 2021? For not
Well, what's
taking
going
it
to
in
happen then is you follow the same rules for 2000, determining your balance at the end of 2020, and you apply the age factor to determine your required minimum distribution in 2021. What Congress was concerned about was that with big hit in stocks in 2020, they didn't want people being forced to take money out of their IRAs and 401ks when stocks were at a low point. So they agreed to suspend it for 2020.
Thank you.
All right. Also, it meant if you were going to start taking, we're going to have to take it in 2020. And your first distribution was could have been April 1st, 2021. That one is suspended. You do have to take a distribution for 2021. So you need to factor that in.
Rick, I think Barbara's question may have been, is it doubling up in 21? And I think the answer is no.
No.
Thank
No,
you.
you don't have to double up. They just suspend it for everybody, so you only have to take out one distribution. Comes 2021. Right. One thing you may want to think about with this suspension of the required minimum distributions is possibly doing a Roth conversion. Right? When you do a Roth conversion, the money is taxable, and it's taxable, but it goes into the Roth, and then once you're 59 and a half and you've had a Roth account for 5 years, then both the contributions and the earnings are going to be tax-free. I can't, sorry. I can't, I couldn't hear the comment, so I'm not, sorry. Okay, so generally with Roth conversions with required minimum distributions, you have to take your required minimum distribution first. And then any monies you want to take over and above that, you could roll over to a Roth. Okay, but you gotta look at your tax situation and see if it makes sense to do it, because you are going to have to pay the taxes today.
Is recasting allowed, or did they get rid of that?
Sorry, the recasting?
Recast. Yeah, if you took it out and then wanted to put it back, if you took it out and put it into
Right now, the recharacterization, where you're going to undo a Roth conversion,
yeah,
that Congress abolished.
last year, right?
Once you do a Roth conversion, you can't undo it. So that was a change they made, and something, maybe they just wanted to cut down on the tax bite. People may start reversing it. Okay, another thing to consider when it comes to required minimum distributions. Again, it may not apply for 2020, but you may want to think about it going forward, is that if you're over 70 and a half, you can make a qualified charitable deduction out of your IRA. Okay, so if you want to, and if you do it as a qualified charitable deduction, then it's not treated as income, but you don't get a deduction for the contribution. So basically, you're getting, by not counting it as income, you're getting a deduction for your charitable contribution. So that's just, again, something to keep in mind. 2020, again, you're not required to do anything. far as required minimum goes, but, but it is there if you're, if you're concerned about making a contribution this year. Or if you're going to do something, say, beginning of, in January of 2021. One thing that was inserted into the tax laws, again, only for 2020, they're going to allow a $300 cash contribution to charity and have it deducted, what they call above the line, in calculating your adjusted gross income. So you could, if you make, again, $300 cash contribution, and you're not itemizing, you do get that adjustment on your return. It's only for 2020 though. Okay, unless Congress should extend it. But at this point, we haven't heard anything about extending it. The other thing you got to factor in when it comes to taking RMDs or doing a Roth conversion is that it is additional income, and that additional income may push you up into a higher category. So you want to look at that. Again, you think you're saving one way, or you think it's only going to cost you one thing, but if you're going to get hit with additional Medicare premiums, that's an additional cost. Let's see what else. Another thing you got to keep in mind, I've talked about federal rules, but Jersey does have certain rules that you need to factor in. Okay, one of them is your property taxes. Jersey allows you a deduction for the full property taxes, not income, but property taxes. On the federal return, you're limited to $10,000 in total taxes. So you may want to think about at the end of the year, do I want to do any prepayment of deductions, prepayment of expenses like you usually do? Or do I want to defer some income if I have a choice? Again, when it comes, say, to capital gains and losses, do I want to take that gain now, or do I want to wait? So there's a lot of different things you need to factor in towards the end of the year. It's not a simple, choice of one or two things. All of us have situations where we have different things going on. And again, what may be good for one person may not make sense for another. So I've heard it all through my career. So-and-so got a tax break with such and such. And I said, yeah, so-and-so may have gotten a tax break, but your situation is different. That person had a lot of capital loss carry forwards. You do not. So that person may have taken some capital gains. So, so you should be looking, at your current situation. And again, you do have choices over, charitable deductions. Most of us, I know, or just about all of us, are on a cash basis. So being a cash basis, it's income when we receive it, and it's an expense when we pay it. So look into trying to bunch your deductions. With the higher standard deduction, now it's about, a little over 13,000 if you're single and you're over 65. And it's about 27,000 if you're married joint return. So you should look at your deductions and see, does it make sense to try to bunch them up? If my standard deduction is 24,000 or say 26,000, and my itemized deductions are 18,000, I'm not going to get any additional benefit unless I claim, let's say, another $8,000 at least for charitable contributions. Does it make sense to try to bunch the deductions in 1 year? So if I think I'm going to give 8,000 this year and 8,000 next year, maybe it makes sense to make 16,000 in 1 year and nothing in the following year. Okay, the same can hold true with medical expenses. Right? Again, you're going to have, assuming you can time these things, you may decide when it comes to, say, a dental procedure, should I pay it all at once this year? Should I try to pay it or most of it next year so I can bunch my deductions? Right? By bunching the deductions, I try to increase my itemized deductions for that year. And if I can exceed the 13,000 or the 26,000 standard deduction, then I'm going to get an extra benefit. So that's another thing that you want to take a look at. When it comes to things, let's see, itemized deductions right now include just medical deductions, income and real estate taxes. That's limited to 10,000 in total. You got mortgage interest and investment interest. Investment interest, you buy stock and you borrow money from your broker. That's generally treated as investment interest, and you can deduct investment interest to the extent of your investment income. It generally includes dividends and interest. And capital gains if you make a special election. The capital gains are not included. Okay, and then, so you got medical, you got taxes, you got interest, and then the fourth category is charity. And what have you given? Okay, a special rule with charity is if you give appreciated securities. Hey, you bought, again, AT&T, you paid $1,000 for those 100 shares. And today it's worth $10,000. If you donate those 100 shares to charity and you've held it more than a year, so it's would be long-term gain if you sold it, then you are entitled to claim a $10,000 charitable contribution, fair market value of the stock. So that may be another way of trying to donate to a charity of yours and not necessarily incur an extra capital gains tax in the process. All right. It also enables you to give a little bit more to charity, because if you sold the $10,000 and you paid the tax, okay, you may only have, say, $7,000 left over. Then you'd only give $7,000 to charity. But if you give the stock directly and you give the $10,000, okay, you get a $10,000 deduction, and the charity is more than happy to sell it. And since they're a qualified charity, 501c3 organization, they do not incur any tax upon selling it. So they're more than happy to sell it. The 10,000, the 9,000 that would have been taxed to you, it's basically absorbed by the charity. So they don't pay tax, they get the 10,000 and you benefit by giving appreciated securities. As I had mentioned, the other thing is, if you're not giving securities, but you're close to the standard deduction, you may want to do the qualified charitable deduction out of your IRA to try to claim a benefit that way. All right. Again, the way that works, you make a, say, a $5,000 contribution. It's made directly from the IRA to the charity. Okay, you can't take possession of the money. The check can be made out and sent to you. The check's made out to charity. Say you want to give it to the American Cancer Society. The bank can mail you the check, and then you can turn around. It's already made out to the American Cancer Society. They then, you can then take the check and mail it in, you know, with whatever correspondence you want to do. But it's got to be made by the bank or the broker to have this qualified. Again, if it's 5,000, it reduces what your taxable required minimum distribution is. So keep that in mind. I'm just trying to think what other things. When it comes to inherited IRAs, I think we had talked about it briefly last year, but Congress did enact the change. And now the rule is if it's other than your spouse, minor children, or disabled children, then the monies in the inherited IRA have to be distributed within 10 years. Okay? It used to be over your lifetime. If you're the beneficiary, you determine your life expectancy, and there were tables to go by, and you could spread it out. But starting with 2020, they changed the inherited beneficiary rules so that it's got to be distributed in within 10 years. Okay? You can take some of it out in each year. You can take it out all in year 1. You can take it out all in year 10. It's got to be fully depleted by the end of the 10th year. So that's also something just to factor into your planning. If you're receiving something now, or you just started receiving it and you're subject to the 10-year rule, keep that in mind. Right? Do I want it all bunched at once, or do I want to spread it out? How do you want to do it? Let's see. One thing I did read about, again, it's only proposed. So, but there's a bill that's being considered by the House, and supposedly it's on a bipartisan basis. They may raise the required minimum distribution age. Talking about raising it to 75, but again, it's only in a proposed form. But just again, to let you know what I've been reading about, and it's possible things might change. So instead of 72, it could be pushed back to 75. It could. But right now, the law is 72, unless you were 70 and a half prior to January 1st, 2020. Else I wanted to go over. When it comes to municipal interest, okay, right now, municipal interest, state and local interest, is tax exempt for federal purposes. At the state level, it depends on what state you're in. Generally, the states, for state purposes, will not tax their own interest. So here in Jersey, we get New Jersey bond or a Monroe Township bond, and we collect interest. It's not taxable for state purposes also. But if you live in another state, you live in, say, in New York or Pennsylvania, and you collect New Jersey interest, it's taxable for state purposes, but not for federal. Another thing, keep in mind when it comes to municipal interest is that it does get factored into calculating your Medicare premiums. So you take your, what they call your modified adjusted gross income, and you add in your municipal interest. And if that pushes you over the 87,000 single limit or 176, then you could be subject to a Medicare surcharge. So that's, again, something else you need to just keep in mind when you're, when it comes to investing. When it comes to real estate, we still have the rule that you can exclude 250,000 gain from your principal residence if you're single. If you're married joint, it can go up to 500,000. So if anybody just, sold their principal residence and they have been living in it for more than 2 years, the general rule is that the first either 250 or $500,000 of gain is excluded from tax. You're fortunate enough to have a larger gain than anything over, say you're married joint, anything over 500,000 is going to be treated as long-term capital gain. Okay, but I think since most of us are here now, sold our prior residences, that may not be an issue right now, but just in case if there's a family member or a friend, that rule is still in place. At this point, I've covered most of the things I wanted just to highlight, and I'll open it up for questions. If there's anything specific that someone has, I'll do my best to try to address it. Anyone have any questions?
Yeah, Rick, what do you hear about eliminating step-up on capital?
That is a proposal that President-elect Biden has talked about doing. At this point, it's too early to say what's going to happen with that. Okay, part of it may be who is going to control the Senate. If it's held by the Republicans, I would guess it's probably going to have a tough time getting through. That's, again, purely my guess.
If they do eliminate it, would it be in a 1 year period, or could they do it from July or something like that?
We'd have to wait for legislation to see when it's going to be effective. How are they going to treat any unrealized gains at this point?
Thanks.
Okay. The Senator Wyden from Oregon, who is a ranking member of the Finance Committee, has talked about taxing your unrealized capital gains. So that means I don't have to sell the stock. It just means if my AT&T
When would they do that?
if I had my AT&T stock at $1,000 and now it's worth $4,000, my unrealized gain is it's 3,000. So Senator Wyden has talked about, let's tax that $3,000.
That would be every year?
It sounds like a nice concept, let's an easy way to raise money, but they have to work out a lot of technical rules. Because suppose I have that stock, it's 4,000 the end of last year, but now this year it's only 3,000. Will I get to factor in my $1,000 loss for the year? Again, it's only a proposal and something they've only talked about in very general terms.
Well, I would,
We'd have to wait until they come out with actual legislation and then see exactly how it works.
I would suppose that you'd step up the basis for the recognized gain, creating,
Probably. They'd have to make some adjustment if you recognize unrealized gains.
Yeah.
But you know, the market's going up and down. So again, I bought the stock at 1,000. Now it's worth 4,000. I pay a $3,000 gain on my unrealized gains. But if it drops next year to 3,000, how are we going to treat that? Do I get some of it back? Do I have a loss for the current year that I can carry forward? Again, that
And
has
so-
not been addressed yet.
I don't understand. You're saying that you'll have to pay taxes even if you didn't sell the stock?
That is what the Democrats are proposing. Senator Wyden from Oregon. He wants to tax your what's called unrealized capital gains.
That doesn't
So
sound
again, you haven't sold the stock.
wholesome.
That doesn't make sense.
I know it doesn't make sense, but I mean, there are traders out there that mark to market, but they're in the business of trading, and you're allowed, you know, one year you have gains, another year you have losses. You know, you get a benefit for the losses the following year.
But I
those
suppose
are
it doesn't
traders.
include 401k, right? It doesn't include 401k.
It would not, no, if it's inside your 401k, any activity inside it is not taxed.
Right.
Okay. There was a question about the stimulus payments that we received. If you received the $1,200 or $2,400 stimulus payment, okay, Congress specifically said that that stimulus payment is not taxable. So $1,200 or $2,400, depending on your situation, that's not going to be taxed. Now, what they're going to be doing with other benefits, such as if you had a business and you had the payroll protection program, there's still things unclear about that, but that's more to do with if you're in a business. You ask for a loan through the business. Let's see.
Rick,
Question?
there's one point that you alluded to earlier, but I'd like to maybe expand a little on that, where you have these deductions that exceed the standard deduction. And people should consider actually pushing income into the year to get those deductions. So that's something that,
Well, the only thing is, by pushing income into it, you know, you're basically diminishing the value of your deductions.
no, what I'm saying is, let's say there's 24,000 available standard deductions, and you added everything up and your deductions are 25,000, all right?
Okay.
I'm saying pull in another 1,000 of income from the next year where it would have been recognized and pull it into the current year. I mean, it's easy to do if you're in self-employed very often.
Right. But again, that's going to be a situation where I tell people, you know, you got to run the numbers and see exactly what effect does it have on your situation. All right. Because now, again, if you have higher income, you may find that now you're subject to a Medicare surcharge.
Yep, absolutely.
Right? So all of a sudden you took another $1,000 in, and now your Medicare premiums go up, you know, another $100 a month or $200 a month. So that's why I said there are a lot of moving parts when it comes to taxes that you need to factor in.
Question.
So,
It's going
Yes,
back
Ed?
to your Roth conversions. Did the
Yeah.
law change? I have many IRAs, but one of my IRA is called an after-tax IRA. When I semi-retired, I wasn't allowed to do a Roth. I had too much of an income. So they had me do an after-tax IRA. Can I isolate that now and convert only that, or the law still says it's the overall?
when it comes to IRA accounts, you have to, your after-tax IRA contributions give you what's called basis in your IRA. That basically means when you take a distribution, some of the distribution is a return of those after-tax
Exactly.
contributions and is not taxed. However, with IRAs, you have to aggregate all your IRAs.
You still
Can't
have to.
just say, I'm taking it out of my after-tax. If I have 100,000 in regular IRAs and I got 50,000 in after-tax IRAs. So I have 150,000 in IRAs with a $50,000 basis. So what that would mean is approximately 1/3 of what you take out of your IRA is not going to be taxed. So that may make sense to distribute some of that after-tax IRA. And one of the main reasons is the Roth IRA does not have a required minimum distribution
That's
requirement. Okay, an IRA does. So if you leave it in your IRA and then comes 2021, and assuming you're over 72, all right, you have to take a distribution out of that, some proportion out of that 150,000 IRA that you have. All right, using the numbers I gave, approximately 1/3 of that won't be taxable, but you got to take some money out. If you convert it to a Roth, you're not, and it's your Roth, you're not required to take any money out.
But can I just take that one account and convert it to a Roth?
Unfortunately, it doesn't work that way.
Okay.
They aggregate the IRAs.
Okay, it's the same way as before. Thank you.
Okay, so, people have asked about that. Can I only take it out of my after-tax IRA? And the government says, no, you have to aggregate everything and take a proportion. That's
Okay.
just the government's position at the present time.
Thank you.
Okay, things can change, with the new administration, new Congress, you never know what they may do. And they may have, a lot of different rules comes next year. So as I explained my tax class, I said Congress makes the laws, Congress amends the laws, Congress can repeal the laws. Then they can make exceptions. It's always, what's the general rule? What's the exception? Where do you fall into? That's where you have to, you get into the nitty-gritty. Okay, we have anybody else? Have any questions?
Yes, I have a question. Is there
Yes, Pete.
if you were to take money from your IRA and you had to take that RMD, is there a limit on the amount you could put into a Roth?
At the present time, no, there is no limit. But what you have to keep in mind is the required minimum distribution cannot be rolled over into a Roth. So if you have, I'm making up numbers, you have $100,000 IRA and your required minimum distribution is 4,000, that 4,000 cannot be, you have to take and put it in your pocket. If you take out anything over the 4,000, that's what could be converted to a Roth. So if you wanted to convert $2,000, you take a $6,000 distribution, or you have to put in your checking account and spend. The other 2,000 you can roll over into your Roth. You have $6,000 of income that year, but that's what you can do.
So anything over the RMD, you can, if you take extra out, you could put that into a Roth.
Correct. Correct. But the thing to keep in mind is you're incurring this extra tax. Where are you going to get the money to raise the extra tax money? Ideally, you want to have other investments where you can take the money out. So if you want to convert your, again, using the numbers that we just did, $2,000, if you don't have any outside monies, you may have to take, say, 500 out of that 2,000 to pay the tax. And then you only are rolling over 1,500. If you roll over the 2,000 and I can get the extra, again, hypothetical tax of 500, I can get that from my taxable account, then I've put the full 2,000 into the Roth. And I pay the tax with other monies.
Okay, thank you.
Okay? Got anyone else have any questions? Okay, well,
I see Michael Bauer is here. Mike, do you want to say anything?
I'm just listening. Thank you, Lynn.
Okay. All right. Rick, I appreciate your willingness to talk to us, and if there are no more questions, we can call it an evening. Otherwise, yeah. Anyway.
if anyone has any further questions, you can always, you want to give me a call. I'd be happy to try to address it.
I have a quick question again, Rick Picasano. If I wanted to invest in the 401 or put money in the Roth, I'm not working. Is that not allowed, or can I do that? You have to be working to put into a Roth?
To be able to make a contribution to a Roth, you have to have compensation. But if you're doing a conversion, you have an IRA already, and now you want to put some of that into your Roth, that there's no requirement to work.
Okay, thank you.
Okay. Thank you very much, Rick. Appreciate your coming to the meeting and talking. I know you come to the meeting previously, but
Right.
Yeah.
I spoke last year in the clubhouse.
Yeah. That won't happen for a while.
Well, maybe hopefully a year from now we can use the clubhouse.
Yeah, we'll hopefully. Yeah.
Right.
Thank you, Rick.
Okay. Does anyone else have any comments or remarks or questions? No? Okay.
Yeah, George? Oh.
Thank you.
Thanks, Rick.
Yeah.
Okay.
Thanks, Rick.
Okay.
All right, everyone.
Have a good evening.
Have a nice evening.
Okay.
Thank you.
So long.